Hello and welcome to today's lesson. We're going to be covering depreciation, and today we're going to look at the T accounts. Okay, so first of all, well, let me just get my tools ready here. Let's just go through the question completely, all right? So now I told you guys that with any question in accounting, the dates are really important. So 1st April 2011, that's the date. Lynn purchased 2 motor vehicles for business use on credit from Villa Motors Limited. So we purchased 2 motor vehicles from Villa Motors Limited. Okay, vehicles cost 12,000 each. So 2 vehicles, 12,000 each. 1st April 2011. Okay, now notice another thing, you bought it on credit. So do you see any cash or check over here? No, you don't. Like this is the price, okay? But it's not the method of payment. So here, you bought it on credit from Villa means you haven't paid them, okay? So do you owe them money? Yes, you do. So in this case, you bought 2 motor vehicles, each of them 12,000. So the total cost is 24,000, okay? So depreciation is charged on motor vehicles at 20% using the reducing balance method. So remember the formula for reducing balance, cost minus total depreciation into percentage policy. A full year's depreciation is charged on the year of purchase and none in the year of sale, means that whether you bought it at the end of the year or beginning of the year, it doesn't matter. If you bought it, you charge full year, okay? And the other method is proportion. Like say, for example, your year is from January to December. If you buy a motor vehicle on December, right? Even if you buy it on December, you give it a full year charge. That's what full year charge means, a full year's depreciation charge. Now, the other method is called a monthly charge. We will talk about that later. But here, what it means that as long as you have it, you charge completely. Okay. So on 23rd January 2013, one of the motor vehicle was sold for 6,500. So he had 2 at this year, and then he sold 1 for 6,500. Okay, so let's just look at the question right now. So show the journal entry to record the purchase of motor vehicles on 1st April 2011. Right, so now I'm going to show you guys journal entries for let's see here. So journals for depreciation. Okay. Now the first thing is record the purchase of a non-current asset. So when you buy a non-current asset, the answer is simple. Debit non-current asset. Credit is cash, check, or the supplier's name. Okay. Now in this case, the answer is debit motor vehicle for 24,000 in the debit column, credit Villa Motors Limited for $24,000. Okay, now another thing you got to know is that this is on the credit column, this is on the debit column. Okay, so I'm just going to space them out a bit. The other thing is, like, 2 marks, so 2 entries. Narratives are not required, so you're not like, narratives means that explanation. Okay, so a narrative would look like this. Okay, being motor vehicles bought from Villa Motors Limited on credit. So a narrative is like just a summary, like a description of what the transaction was. You just start with being, and then you just give a short description of what happened. And there is no right answer for this. Okay, but that's what a narrative looks like. And they told you not to show that. Okay, so now recording depreciation for the year. Now this is not given in this question particularly, but like it's there in your MCQs. Now, whenever you charge depreciation, remember, depreciation is an expense. Whenever you have an expense, you write debit income statement, credit provision for depreciation, okay? The same amount. So just remember, your debit and credit will always be equal, okay? I'm gonna come back to this and show you guys how it looked like. The other thing is disposal of a non-current asset. Now, when you're disposing of an asset, think what's going on, okay? So you're sold a car for cash, okay? And you should know that, like with cost value 10,000, receiving cash 5,000, and total depreciation till date for 3,000. Okay. Now, I'm just going to tell you guys, with every non-current asset account, there is like three aspects here. There is like the asset, there is the depreciation, and there is the cash, okay, or the money, the bank amount. So let me just write it out for you guys, because a lot of times when you write it out, it looks better. So first thing is you got bank, okay, or you got cash, right? The amount. And in this case, like I'm just going to put the figure. So 5,000, debit, depreciation, provision for depreciation. Okay, 3,000, credit, non-current asset, 10,000. And now if you look at the debit and credit side, right? So debit side is 5,000 for 3,000, 8,000, and this side is 10,000. So the balancing figure will be debit income statement for around 2,000. Okay, so this might be going over your head right now. So let me tell you exactly what happened. I sold a car. When you sell a car, is that debit or credit? Credit, right? So credit non-current asset, or you can write credit car in this case. The cost price, 10,000. Okay, remember, this is a cost account. Okay, now the other thing is I received money because I sold the asset. Okay, I got 5,000 here. Do you guys agree with that? I think so, right? Debit bank, because we got money for selling the asset. The other thing is, if you sell the asset, does the depreciation exist anymore? No, it doesn't. So when you remove depreciation, debit provision for depreciation, 3,000. And the other thing over here is that, so 5,000, I got money, 3,000 depreciation doesn't exist anymore. So we remove it. That's a good thing, debit. And credit non-current asset, we sold that car. So cost price removed for 10,000. Now, 8,000, 10,000, 2,000 is my missing figure. So I put it on the debit side, okay, for income statement. Now, if debit income statement means it's a loss, okay? So like, that's how you figure it out. This is what a journal entry looks like. Now, remember, I'm just gonna put this a star mark here to show that this is the balancing figure. So I'm just gonna write balancing figure. If a lot of you guys are confused about what's going on, I think you guys need to understand that these are journal entries that you have to sort of learn, because these are examinable. These can easily come in your exams. Okay, so this is the journal parts done. We're going to look at the depreciation account, right? So depreciation account. Now, I'm just gonna stick to the question here, okay? I'm just gonna show you guys the question. So prepare the provision for depreciation account for the years 31st March 2012 and 2013, and you've got 5 marks for this. Okay, so let's open up our Excel sheet here. My God, imagine if someone pauses the video and tries to see what I need to have. Okay, so let's just draw the border. Here we go. Over here, it's a T account. Let's just make the T account. Okay, so I'm just gonna. can imagine like if I upload this on YouTube, people are going to be commenting that this should have been done beforehand, but okay. All right. So day details, dollar, day details, dollar. Okay. So here we go. Provision for depreciation account. Okay. So let's just expand that a bit here and here. Okay. Right. So let's just dive into it. Now, the first thing you got to know is that in 2011, right, they didn't ask us to calculate for the year ended 31st March 2011. So let's look at the date. The date is 1st April. Okay, that's 2011 is when you bought it. Then 31st March 2012 is your first year. And then 31st March 2013 is your second year. So you got to know that this two is 1 year and this is the second year. Okay? Because here it's like, you know, from April is the beginning, March is the end, then this is the beginning, then this is another end. So 2 years of accounts, okay, over here. So I'm just going to color it. This is the second year. Here we go. Right. So now, first year you bought vehicles brand new, so you don't have any balances, right? First year, if it's brand new, you don't have any depreciation balances. Okay. So what we need to do is that directly just write income statement, okay, and show the calculation for depreciation. So in the first year, we had, remember the formula is cost minus total depreciation into percentage, right? So this is the formula. We got this and this, okay? So this is the formula. Our cost in this case is 24,000. So 24,000 minus my depreciation, which is 0 because it's brand new, right? Into percentage, which is around 20% here. Okay, so my first year's figure is this formula over here. What I got is, let's see here, 24,000 into 20%, which is 4,800. Okay, so 4,800 is my income statement. Do I have anything here? Nope. So balance CD carried forward, 4,800. Okay, and close the accounts. So 4,800 here, 4,800 here, and this should be balance BD, 4,800. Okay, now let's look at the dates. This is the end of the year, the 31st March 2012, right? So same dates for both. This is the beginning of the year, so this is 1st of April 2013. Ooh, yeah. This is 1st of April 2012. Okay, so this is the beginning of the new year. Right. So now we need a few more of these columns here. So let's just go and make them. Right, so I'm just going to extend my account. Okay, so now remember, under the dashes is a new year. So this is for the second year. So in this case, let's just see what we need to do. Now remember, in my second year, I sold one vehicle. So I had only one vehicle left. Okay, so in this year, I had two vehicles. Here I had only one vehicle. Remember, two vehicles costed 24,000, one vehicle costed 12,000. Okay, two vehicle had depreciation of 4,800. Okay, now remember, one vehicle's depreciation for first year for one vehicle is 2,400. Okay, I'm just gonna merge this up. Right. Now this is very important because there is two things we need to do. First is on 23rd January 2013, we sold a vehicle, so that depreciation is not there anymore. We remove it. Okay, so as long as the vehicle doesn't exist anymore, you remove the depreciation. So we remove the depreciation for first year, which is 2,400. So out of these two vehicles, one was gone, and that vehicle's depreciation was 2,400. Now, the vehicle that remained, we need to charge depreciation on that. So 31st March 2013, provision income statement. I'm just gonna, like, again, we write the formula out for your convenience. So cost minus total depreciation into percentage. I'm doing this because it's the reducing balance method. So in this case, the cost is 12,000 because we have only one vehicle, 2,400 depreciation from the first year, and the charge is 20% for this year, okay? Wow, relying on a computer, I guess. Okay, so this is your depreciation charge. We should get something like, let's just do it out here. 12,000 minus 2,400 into 20%, which is 1920. So that's your depreciation for one vehicle for the second year. And now we need to close the accounts here. Closing the accounts is traditional. We need to add both sides. So we add this side and this side, heavier side on both sides. So 6720 here. Balancing bigger, balance CD is 2,000. This minus this. Okay, I'm just going to show you again. I got this by adding these two figures only. A lot of times what people do is they add everything, or they add only this. You need to add only the balance brought down and that, okay? Anything from under that. Yeah, I just got a text. Okay, so right, so balance CD, always remember, bring it down for next year. So this is on 31st March 2013. This should be 1st of April 2013. Balance CD for 4320. Okay. Notice that this is like 2 years depreciation. So this is around 2,400. Okay, 2,400 plus 1920 should give you the amount that is here, because this is like for one vehicle for 2 years. Okay, so that's essentially what it is. Right, so let's just move on to the next question, which is disposal account. Okay, so disposal account, remember, let's just do it here. Okay, let's draw the borders up. Okay, let's create the account. Disposal account here. Date, details, $sign, date, details, $sign. Right, so here, remember, disposal account, first write out the format, asset at cost on the debit side, bank on the credit side, provision for depreciation, okay, ADB, so asset depreciation bank. So just this, right, depreciation, ADB, just put your like ADB, asset depreciation bank, okay? Now, asset over here, what did you sell? You sold one vehicle at cost of 12,000, okay? One vehicle that was sold. So we're dealing with this right now, the vehicle that was sold. We call that as disposal. Now remember, this 6,500 is the bank amount. So if you want, you can write asset cost, asset cash received on sale. Okay, asset cost was 12,000. Assets received when you sold it as 6,500, and the depreciation before sale. Okay, this is on year one. On year one, when you had that depreciation, it was how much? This over here. So this is first year's depreciation before you sold that. That was 2,400. So here, depreciation is 2,400. Bag is 6,500. Okay, so let's just close the account here. Okay, so let's just draw the borders. Right, so this side is this plus this. How much do we get? Is it weaker? Yeah, so if it's weaker, we're just going to take the heavier side on both sides. And on the difference side, we're writing income statement. We're just going to put the difference here. So this minus this minus this. Oh my God. Okay, I'm just going to manually type it in. So 12,000 minus 6,500 minus 2,400. So our income statement, which is been, okay, is 3,100. Right. So is this a loss or a profit? It's on the credit side, so it's a loss. Remember, credit is always like in the account. If it's credit side, then it's bad thing. So it's a loss, 3,100. Okay. Remember, if you wanted to show this as a journal entry, it would be debit income statement, credit disposal. Now, a lot of you guys seem to get confused with journal entries. Remember, at the end of the day, it's still on the credit side, right? But which account is it on credit side? Disposal. So credit disposal, hold your finger on disposal. So one finger on disposal, and you know that disposal is credit. So on credit side of disposal, what do we write here? The opposite account's name. Okay, this is class 8 or basic accounting. I mean, I'm calling it basic, but if you're still confused about it, it's fine. But I'll just, I'll take more time to explain to you guys. But this is what the journal looks like, okay? And this is a loss on disposal, right? So they're asking for two other methods of depreciation. It's very simple: straight line method and revaluation method. Okay, so that's the thing over here. All right, that's all for today. I want you guys to copy it out, and definitely we'll carry on in the next class. Okay, take care. Bye.